Because we're looking at the processes of financial management, it's important to look at the monitoring and controlling. So it's all very well and good to plan and make budgets and all that sort of stuff, and actually, do them. But you need to monitor and control them. And what does that mean? It means looking at what did we expect as a business, what actually happened, where it went wrong, if it did go wrong, and then working out ways to fix it. Now, the three main, monitoring tools that we use are the cash flow statement, the income statement, and the balance sheet. Now, you may already understand these, or you may think you understand them, but just make sure that you go through and make sure that it's very, very clear in your mind the purpose of each of these and how each of them works, because you can get questions, about how they work and all that sort of stuff. It's unlikely, that you're not going to get a question about making one of these, but you do need to understand them. The cash flow statement measures the inflows and outflows of cash. And the big question there that you're trying to answer using a cash flow statement, what do you use it for, is to try and work out, will we have enough money? So you do it in advance. You go January, February, March, and then do all the months in advance. You look at the inflows that are expected. How much revenue are we going to make? You look at the outflows, the bills and things that have to get paid, and try to work out, are there any months where we have a shortfall? So will we have enough money? Now, this happens over a period of time. So a cash flow statement is usually going to have all the months of the year. And it usually is that period of time is going to be 1 year. An income statement categorizes the spending. You put the sales right at the top. Okay, we made the sales, fine. But then it categorizes the spending to try and work out the final answer of, did we make a profit? And what it can tell you is if you have made a profit that you're not happy with, or you haven't made a profit at all, because it categorizes all the different spending, it helps you as a financial manager work out where the business is going wrong. And again, an income statement is one of these over a period of time type of things. So it's over a period of 1 year. So the income statement will have at the top, 1st of July this year till the 30th of June the next year. This is the income statement. Over this time, what happened? The balance sheet is a little bit different. It shows what the business is actually worth, and it tells investors especially, but also places like the tax department, how we financed our assets. How did we pay for all the things that the business actually owns? Now, this is a little bit different because it is at a point in time. So the other two are over a period. You'll have one date to another date, and it covers all of those. But the balance sheet is actually like a snapshot. It's a point in time. So, for example, June 30th, 2013, this is what the business was worth at that time. So starting with the cash flow statement, we're going to go into a little bit more detail. The big question is, why would you use one? The first reason is you need to plan. You plan for months where the outflows are going to be bigger than the inflows. Maybe you need to save from previous months, especially like a seasonal business. You might need to save over the summer months so you can keep the business open during the winter months. So the outflows being more than the inflows aren't really a problem if during some months the outflows are a lot less than the inflows, right? As long as overall it works out, then the business can keep going. You might also need to get some extra finance, especially in the form of an overdraft. If you find a month that you see that you're not going to be able to make it, you're just not going to have the money, but the next month is going to be fine, we're going to make tons of money, then you can go for something like an overdraft, something like a very, very short-term loan from the bank that can allow you to keep functioning until the business kind of picks up the next month. The other reason is to use it to adjust the numbers where maybe your expectations were higher than what the actual results were. You expected a lot, but it didn't quite get there. Maybe the predictions were a bit too optimistic, or maybe there's some area of spending that comes up as a problem, and because every little area of spending, every little cash outflow is recorded there, you can track it over time, and you can track it compared to the other expenses of the business. This is kind of what the left-hand side, the kind of headings and subheadings look like of a cash flow statement. Really, the way that it works is that money or cash, because we're not talking about literal cash here. Usually, we're talking about money in banks and things. The cash flows in and out for three basic reasons. So even though you're not going to have all these colors, you're not going to have it separated like this. It's just going to be, if you do get a question about it, a black and white, boring looking thing. This is actually what it means. The top part is usually the first and the section that you're probably going to be most interested in is the business's operating activities. Now, if you look down there, you've got net cash flow from operating activities, cash flow from investing, cash flow from financing, but you see that word activities. So if you think of the business doing three main activities, three main reasons why cash would flow in and out, that's how to look at a cash flow statement. So the operating activities are money in and out of the business that comes from running the business. So if you can see on the left-hand side there, I've actually color-coded it so you know which ones are inflows and outflows. Hopefully you understand green and red. And you're not colorblind, sorry. But the receipts from customers, so customers paying you, that's cash inflow. So I've got a green there. Payments to suppliers, that's part of the operating activities. So paying suppliers, that is an outflow. Payments to employees, that's an outflow. So those are the operating activities. There's also, secondly, the investing activities. So this is money in and out for equipment and for property. And you can see it's very simple there. You've got purchases of equipment and property are red. They're cash outflows. You buy equipment, money goes out of the bank. You buy property, money goes out of the bank. And you can also sell the equipment of the business. It's not going to be a common thing. Hopefully I'm not constantly selling the property of the business. But it is a cash inflow if you do sell that. The third section is a cash flow from financing activities. This is money in and out for loans and investment into the business. So you could get money from borrowings, and in a cash flow statement, because the money is actually coming into your account, even though you're borrowing it, the proceeds from borrowings are actually going to go into the financing activities as an inflow. If you're paying the borrowings, if you're repaying the principal, so if you're repaying the principal of a loan, then that's going to be cash outflow. Right? So even though you go, oh, the debt's bad and all that sort of stuff, for a little while, it's a cash inflow into the business. That's why you do it. That's the whole point. At the end of each month, what do the owners want to know? They want to know, firstly, how much did we add to our bank account? And secondly, how much did we start the month with? So in the end, we want to know how much cash is left now. And that lets them take corrective actions if they need it. So instead of saying the business owners can fix it, the nicer way of saying it is to take corrective actions or take corrective action to fix it. And that's really what the business owners want to be able to do. But it's more than just like an autopsy. It's a planning tool. You're not just looking at, well, where did we go wrong? The finance department is supposed to make a detailed 12-month cash flow statement to predict the future cash flows. In fact, a lot of businesses have a 12-month cash flow statement and a 5-year cash flow statement. And that way they can see the shortfalls coming months in advance or even years in advance, and they can plan for it. They can actually make sure that they have the finance for it. So what it looks like in the end is you've got, I've got January, February, but it goes all the way to the end of the year. And then right at the end, you've got the yearly total of all these amounts. So the way that it would work is, say for January, after looking at how much money came in from customers and all your payments to your suppliers and all that, say you end up with $20,000 like net. So after you've added all the pluses and subtracted all the minuses, then you end up with $20,000. Wow, we made $20,000 through our operating activities this month in January. Then you look at the investing activities. Say you had to buy some equipment, cost you $5,000. Often that's going to be put in brackets like it is there because it's a negative. It's like an accounting thing. They've got a thing for it. But having it in negatives means that that's a cash outflow. I put it in red, which makes more sense. But you also have those brackets around it to make sure that you know that when it comes to our investing activities, we lost money. Also, when it came to our financing activities, say we had to pay back some loans or something, we ended up losing $5,000 there. So of all the activities that we had, that we did that month in January, the net increase or decrease, if it was in brackets, the net increase in cash held for this business is 10 grand. Now that really isn't meaningful because you need to think, all right, well, what if we were minus 50 grand the last month? Being positive 10 grand this month really isn't going to help us. Let's assume that the cash at the beginning of this period, the cash on the 1st of January was zero. Let's say the business started operating on the 1st of January. Maybe it's like a fireworks business or something, right? So let's say we started with zero. The cash at the end of the month, if you got zero plus $10,000, is $10,000, right? And then if you move on to February, say they have a bad month when it comes to operating. Instead of making $20,000, they've only made net, so after subtracting all payments to employees and supplies and all that, they've only made 5 grand. They've also ended up having to buy some more new equipment worth 10 grand. And they've had to pay back another part of a loan, which has amounted to 10 grand. Now, the net decrease in cash held is $15,000. Now, if you started the month with $10,000, which is the cash at the beginning of the period there, if you started with 10 grand and you subtracted $15,000, obviously the cash at the end of the period is going to be $5,000. That means that you're going to struggle in that month, which means that you probably need to start looking at things like short-term finance, things like that, because you need to make sure that your business can keep functioning in March without having to say to the employees, hey, can you work for free? Because that's how